I'm going to focus the talk in 3 areas, really to give you an overview of the innovation ecosystem and how we at SVB view that, and really kind of an inside view to kind of relationships and network in Silicon Valley. Then I'll get into more kind of the current state of the venture market, what we're seeing in venture capital, which has gone through lots of disruption lately, but continues to be an engine for growth. And then we're going to dive into some sectors and some emerging platforms and areas that we think are interesting that you should all be aware of, and hopefully provide some perspective for you all. So let's get into it. I hope you all can see this. This isn't busy at all, but this is actually a neural map, which is a picture view of a networks derived from the PayPal mafia. Who's heard of the PayPal mafia? I think PayPal was one of the most iconic companies of Silicon Valley. And PayPal alums have gone on to create some of the most impactful companies of our time. We had Peter Thiel, who obviously started Founders Fund, was the first investor in Facebook. We had Reid Hoffman, who started LinkedIn. We had Elon Musk, who obviously is incredible with Tesla and SpaceX. So this is an image showing the networks of this PayPal mafia and the connections between individuals, companies, investors from just that single company. And at SVB, I think it's one thing I want to make clear today is networks are so important and relationships are so important. You all are part of now this Nexus network, which is incredible, right? So every interaction you have, you're part of a new network, and I encourage you all to think through how to leverage that network and make the most of that. So we're going to talk more about this internally, but I wanted to set the stage and give some context there. Just a little bit about Silicon Valley Banks. Most of you are probably aware, but some of you may not be. We've been around over 35 years and are really the commercial bank to the innovation economy. And we define that as technology and life science companies from startup all the way through IPO and beyond, and the investors that serve them. And again, it's a very focused strategy, but it's one that's been very, very profitable and good to us because we've been able to grow with our clients over time. We have the privilege of being the bank for over 50% of all the venture-backed technology and life science companies in the US, and over 60% of companies that went public in the first quarter of this year are clients of SVB. We are a diversified financial institution. We have a funds management group where we invest in funds and companies. We have a private bank. We're now over 50 billion in assets, over 25 billion in loans, as you see, and we're a global bank. And that's been a key strategic focus of ours for many years. So we want to be anywhere innovation is happening in the world, we want to be a part of it. So we have a joint venture bank in China. We've been in Israel for several years. We've been in the UK. We cover Latin America through a team. And I think Dario will be here later as well. But anywhere innovation is happening, we want to be there. And our international business is a very fast-growing part of our business. Again, over 2.5 billion, almost 10% of our loans are now international, and our deposits are significant. And here are some of the clients we serve. Try to throw in some international foot names that you might be aware of. But again, working with the most impactful companies in each segment. Now I just want to talk about the state of venture a little bit. Globally, 2017 was a huge record year, over $120 billion. If we dig in and into the US market particularly, last year was $84 billion, a record year, highest level of venture investment since 2000, when there was $100 billion invested. And the business, you can see the venture business for many years used to be about a $30 to $40 billion industry in the US. And that was pretty consistent and fluctuated within that range. But 2014 was really the beginning of what's now become the new venture market, with larger dollars and larger numbers of deals. And there's a couple things that have impacted that. One, venture funds are getting larger and they're thinking more global. That's one. Two, we're seeing lots of different types of capital come into the venture market. So traditional investors who, for instance, were public investors like mutual funds and other public investors have come into the private markets and wanted to capture some value in companies at an earlier stage. So many mutual funds those types of groups have come in. Also, we've seen family offices, and I want to talk a little bit more about family offices have come into the market. And again, that's impacted just the overall growth of companies' ability to raise money at a private level that we haven't seen since for many, many years. And I think we're going to continue to see this. This is a breakdown, a quarterly breakdown by stage, so you can see each of the stages, and then the blue line is the overall number of deals closed. Again, 2014, you saw that ramp of dollars and deals. We're starting to see a little bit flattening and decrease in terms of the number of companies being funded. And that's, I think, healthy, because I think so many companies were raising money, and quite frankly, not all companies deserve to raise venture capital. But I think with so much capital, many companies were raising, and now I think we're seeing the dollars increase, continue to grow, but the number of deals decrease a bit, so the average dollars per company is increasing. And we expect to see that continue. One of the major segments where venture has grown is in the seed space, so there's been an explosion in seed financing and really micro VC seed funds that have emerged over the last 5 to 7 years. So this is, again, you see the big explosion 2014, 2015. It's still mirroring some of the macro trends where number of deals are starting to decrease the last few quarters, but there's still lots of capital. Our team focuses on working with new seed managers, and we cover over 500 firms just in the US, and that's mainly just in the Bay Area and East Coast, which are the two biggest markets in the US. Everybody wants to be a venture capitalist, and we're seeing new firms arise all the time. Another big trend in venture are companies staying private longer. So who's heard of a unicorn? Anybody heard of what a unicorn is? So a unicorn is a term coined by a good friend, Aileen Lee from Cowboy Ventures, about 5 years ago, who said any company that raises money at $1 billion or more when they're still private is special, and that should have a unique name and designation. So she coined the term unicorn, and now that's become kind of an industry term. And now we're seeing over 130 in the US unicorns. I think there's over 250 globally of companies, private valuation over $1 billion, which is astounding. Again, most of these companies would have gone public 10 years ago. These would all be public companies. But today, these companies are staying private longer, which has an interesting effect on the dynamics of the market. I mean, it's nice to see we're getting more liquidity in the markets today. The IPO market has opened up the last few quarters, which is great. And I think that's the engine that really catalyzes investment activity, M&A activity, new funding, et cetera. This is a breakdown of kind of where money is going. I think you can see about half of the dollars over the last 4 or 5 years have been in information technology, and the biggest component is obviously software, especially enterprise-related technologies. Those are the subsectors there on the right. I'm not going to go into detail there, but I am going to talk a little bit about the artificial intelligence machine learning space in a little bit. I mentioned family offices are becoming a more important source of capital in innovation. We talk to many families who have come to us and say, tell us how we can educate us on this innovation economy, educate us on venture and technology. How do we get involved? And we help educate them. We talked about sectors, we talked about firms, we help lay out a strategy for them. And this is, again, a typical asset allocation model. I think we're seeing many venture firms increase their exposure to venture while decreasing their exposure to hedge and PE. A lot of the hedge fund returns have gone down, and a lot of PE returns have gone down, and a lot of those dollars are flowing into venture. I talked about the rise of the seed investor. Traditionally, family offices have been investing in later stage companies, right? When companies are more mature, less risk, but we're seeing them come in earlier and earlier, and you can see the change from 4% in 2009 to now 26% of their dollars are coming in earlier. And I'm sure many of you come from markets where family offices control a big part of the local economy. So just be aware of this trend that's happening. This is a global phenomenon, and it could hopefully have a positive impact on what you all are doing. Yeah, this is some of the logos of unicorns where family offices have invested more in the later stage, which is traditionally where most of the dollars have been from family offices. Now I want to get into some sectors and talk about a few things that we think are exciting disruptors happening in the market today. Who recognizes this painting? There's one. Do you know the artist? Do you know? Magritte, exactly. René Magritte, the Belgian impressionist, has this is his work, and I'm using this example for a couple reasons. One, while you're in town, Magritte, there's a great show at the San Francisco MoMA with Magritte and other impressionists, so a little plug for the MoMA. Go enjoy some amazing art. But two, the image on the right is really shows, it's an image of an immersive experience that they're doing at the MoMA, where you can put on some AR goggles and see the painting in a different view and from a different perspective, more immersive experience. So the point here is AI is becoming pervasive. It's even becoming into art, and it's touching many parts of our lives. So artificial intelligence, machine learning is booming. It's being integrated in every product that we use today. You probably, if you have a smartphone, you have an Amazon Echo, you have a Google Home device, you're seeing AI at work. It's pervasive and growing. And venture dollars are continuing to be invested into artificial intelligence companies. And it's kind of mirroring the slope of what we saw a few years ago in the big data industry. Big data was a huge area, still is, but huge buzzword and area of activity a few years ago, and we're seeing that same slope of venture activity in the AI space. One area where we're seeing artificial intelligence really focused is in autonomous vehicles. And many of you are probably aware of the space. This is amazing. The amount of capital that's come in to enable autonomous driving is incredible. And this is only about a 4-year phenomenon. But billions and billions of dollars have been invested. I want to talk about a couple companies that I think are really interesting and you should pay attention to. One is Zoox. You see the first company there that's raised a $300 million, actually Series A round, which is incredible. And Zoox is reimagining the vehicle in an autonomous world. So they are taking a holistic approach to what is a vehicle going to look like, feel like, be like if it's fully autonomous. So should it be a front seat, a back seat, a square, a rectangle shape? Probably not. So Zoox is coming up to totally reimagining what the automobile and transportation experience will be like. Another company I want to talk about is Cruise Automation. It's a Silicon Valley company that was acquired by General Motors about 2 years ago for over $1 billion. And they become GM's autonomous technology division. They just raised 2 weeks ago, SoftBank invested $2.5 billion into the company. And GM put another $1 billion into Cruise. And the reason is, in talking to the founder of Cruise, who's still the CEO, he took the money from SoftBank for a couple of reasons. One, he wanted to accelerate the development of their autonomous vehicles. He's promised to have fully autonomous vehicles on the streets by middle of next year. Two, though, is to be able to attract the best talent in the world. And that's where I want to go to next. There's a global war going on for AI talent. There are not enough AI engineers, scientists, machine learning scientists in the world to meet the demand of the market today. So many of the large platform companies, Google, Facebook, Apple, have development centers in different regions of the world to try to take advantage and to try to get an advantage in the market. There's one of our clients called Primer.ai, and I'd encourage you to go to Primer.ai when you have some time and see the power of one use of artificial intelligence. But Sean Gurley, the CEO there, thinks that the next war in the world is not going to be around weapons or nuclear or North Korea. It's going to really be around AI supremacy. China has made artificial intelligence proficiency a national mandate. The US and our intelligence agencies are doing the same. So there's a race going on right now to really see who innovates the fastest on the AI front. Again, this is something to watch, and I think going to be affecting all of our lives in the coming years. Another area, maybe not so significant, but one you've probably played in, aware of, cryptocurrency and the blockchain. This another area that's, again, raised incredible amount of both venture dollars and what's called ICOs, initial coin offerings, where companies offer their own virtual tokens to be used within their sites. There was a huge run-up in 2017 for funding in this area. It's starting to settle down now, but here are a few large ICOs. My perspective and view on crypto is the blockchain's an amazing technology, distributed ledger. There will be amazing companies built on top of blockchain. I think the ICOs, though, most of these, 90+%, I think, are fraudulent and scams. They're just a way for companies to raise money, and they really don't have the business models to support the capital. So be very wary if someone comes to you with a great ICO. Just make sure you go in with both eyes open. The other piece is the big platform companies. The 5 platform companies in the US there, and then the 3 large Chinese companies are all, again, in this theme of racing for talent and innovation and the platforms for tomorrow, are being very acquisitive and acquiring companies aggressively in these subsectors for talent, but also for technology. And we're going to continue to see that because there's only so much they can develop in-house. So M&A from these companies will continue to be robust. This is just an interesting one I'll spend a little time on. Kind of Amazon's HQ2 has been a big phenomenon. Many cities in the US fighting for Amazon to build their second headquarters here. And I think it's really brought up the idea of how significant some of these companies are if they come into your area, the effect they would have on your economy, and two, how innovation is really global. Of course, this is domestic, but we're seeing this across the world, where areas where companies come in, some venture activity, some entrepreneurship combined, and that just starts the flywheel for innovation and activity. And I think it's really exciting. So I don't have a bunch of time. I've kind of gone through this quickly. We'll have some Q&A, but I just want to end. This is a neural map of kind of, we're fortunate to be Switzerland and sit in the middle of all these incredible innovation that's happening. So we work with founders, we work with VCs, we work in government agencies, other service providers, and we're really fortunate to get a view on this. And I would, again, going back to the beginning, I would just encourage you to think about your networks. Think about those connections that maybe you don't haven't touched too often, and see and just see where there can be value over time. Because I think if you look at it, especially visually, and map this out, it could be very powerful.
Thanks. Jim, you mentioned SoftBank and the $2.5 million they invested in Cruise. There's a lot of talk about how SoftBank is going to radically change the venture capital industry. Can you talk about that, about how they're investing way more money than anyone else would ever dare to, and what that's going to mean for Silicon Valley Bank and for other venture funds?
That's a good point. Great question. Yeah, SoftBank, for those of you who don't know, raised a $100 billion venture fund. Right? You just saw $80 billion was invested in the whole venture category in the US last year. They have $100 billion to invest in venture. So there are two sides to that. That could be really good. If you're a company and you're a leader and SoftBank comes in and invests in your company, whether you're a venture investor in that company or you're a founder of that company, they're basically anointing winners, right? They're saying, we believe you're a category winner. We're going to give you $100 million, $300 million, and go off to the races and run. There's another camp that says that's really dangerous. And we've seen it before. I've seen it where too much capital too early in a company life in a company's life is really, really dangerous. Because companies try to do too much. They become okay or good at a lot of things, but not great at any one thing. And so there's another whole school of thought saying that SoftBank, this phenomenon, this trend that's happening. And now, by the way, other firms have followed. Sequoia just raised an $8 billion growth fund. We're seeing several of the large platform venture firms raise these huge multi-billion dollar funds. So I'm a little skeptical. I believe venture is still about, I like keeping companies capital efficient and raising capital at the right time of a company's life. But I'm worried that too much capital will come in too early into the system, and that's really going to dilute the market. And so I think it's dangerous.
Is this another bubble emerging with all the capital going into these companies as they're burning through all their cash? I mean, it really follows up what you were just saying. I mean, there's just too much capital, and they're placing it just to place it. What's the fallout going to be, and when's it going to happen?
Yeah. We spent a lot of time thinking about this. We've been in an unprecedented 10-year bull run, right? Just capital markets, venture capital. And so what's really going to stop it? And, you know, I'm old enough to have been around in 99, 2000 to see the 2000 market crash, and that was not fun. I think this is much different today, but something, we know this business is cyclical. Something will happen. If I were to bet, my sense it's going to be political. I think, you know, and we can talk about this administration and what's happening in the U.S. and trade wars and something, but I think there's got to be some macro political event that shakes the system and kind of resets things. That's my view, but I have no idea. I thought we were going to have a correction 3 years ago, right? Early 2017, Q1, we had a little bit of a blip, but then rebounded right back in Q2, Q3, and, you know, it was, so it's hard to say, but something will happen, and this market will correct. There is too much capital in the system today.
I'm Anurag Kumar with iTexico. I have two questions. What's your perspective on the tariffs, the new administration, the immigration policies, given that a lot of these companies have non-US citizens at the helm, other countries are also coming up. I didn't see a lot of that in America here. So I don't know what's your perspective on that. So that's one question for you. And the second thing is all this information, how does that relate to the attendees in this conference? What do you think there are some opportunities for folks in this room when it comes to nearshoring and the attendees here?
Yeah. So let me take the first question first. I think it's very risky and dangerous what's happening from an immigration with this administration. Because if you look at I think it's the top. Look at all the public companies in the U.S. over the last 10 years. Half of them were founded or led by foreign-born entrepreneurs, right? So immigrants are an incredible part of our innovation economy. And I think there's some risk there, and that's where I get back to what's going to stop this train, what's going to correct this. It's going to be it's a political issue versus a economic issue. So that's my point there. In terms of this, you know, I just think there's lots of new technologies, new disruption. I focused on a couple here, but my goal here today was just expose you to a few areas that I don't know how it will affect your business or impact your businesses. But if you're not doing something around artificial intelligence or have some basic competency on what's happening in the industry, I think you'll fall behind very fast. I don't know how that, again, I'm not familiar enough with the dynamics of each of your businesses or how that will happen. I think near sourcing will continue to be a part of business's strategy, so I think that's good. But I think, you know, everything's being disrupted. Venture business is being disrupted. All kinds of, our bank is being disrupted, right? Financial services industry is being disrupted. We're having to continually change. So I think it's just, I don't have all the answers, but I think it's just be aware of these emerging technologies that could affect us.
What are some of the markers that you see or you look for in a company to know that it's, you know, at the right time? Because you mentioned, you know, this money's coming in too soon, or, you know, the companies aren't mature enough or focused enough.
Yeah.
What are the things you look for?
Yeah. So I think in early stage market, we talk about product market fit. Has the company built a product that customers are buying? Have they found, early product market fit? If that happens, then you raise capital to scale, and you build, you raise capital to really scale sales, BD, and growth, right? The dangerous part is when too much capital comes in to a company that's still, I won't say concept, but still hasn't figured out the basic economics of customer acquisition, lifetime value of a customer, just the sales engine, and doesn't have the basic initial pieces down. And when too much capital comes in too early there, that's dangerous. So, again, a lot of the capital is coming in later stage. Companies have figured out, again, have that product market fit in our scaling, and that's okay. I mean, I think there's still some danger there, but it's really pre-product market fit where I think it's most dangerous.